Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we're exploring green money, how it can help fortify your financial foundation, and how understanding the timing of when you pay taxes could make a big difference in your retirement strategy. And now for our weekly question and answer segment.
Welcome back to Financially Speaking with Ryan Pekka and Ryan Connor from Buska Retirement Solutions. We're exploring green money today, guaranteed income like annuities, and how it fortifies your financial foundation. Fellas, I think financial foundation is a hot topic for most retirees. Would you agree?
Absolutely.
All right, so let's dive into this one. Use the term green money. I've heard you guys use it a million times. What is green money, and what is it in the context of financial planning and income planning?
Absolutely. Green money is going to be safe money. So think green means go, green means there's no risk. So when we're looking at that, think CDs, your bank account, even though it's not really giving you any interest, money market, fixed annuities, government bonds, if you hold them all the way to maturity, and fixed index annuities are the most common examples that we like to use. Basically anything that's going to continuously give you some sort of gains, but without the risk of loss. So typically those investments don't have the same upside potential, but they can let you have some. So different products come out all the time. There are new issuances and things like that that let us kind of follow the market without being involved with it, so we don't have to worry about those down days or a bear market potentially lasting longer in them. So think of it as your safe side of retirement, the money that's not at risk any longer.
Okay, and I know that's one thing that most people, coming from their working years, they get a paycheck virtually guaranteed, but as long as you're employed 15th, 30th, that's something people look for in retirement. You guys have talked about before. Why does that guaranteed income, it can come from Social Security, pensions, annuities, things like that. Why is that so important to people to have in their income plan moving forward?
Well, part of it is, like you talked about, people are used to an income structure like that. I mean, we go through our lives largely budgeting on a month-to-month-ish basis. Yeah. And so people like the consistency that their kind of income structure doesn't really have to change. The sources will change, like you said. Rather than being from a paycheck, it can be from Social Security. If you have a pension that annuitizes. That
mythical creature
pension. There's fewer and fewer of them these days, but they do still exist. Or whether it's something like a guaranteed income stream from something like an annuity. Those can be really useful in terms of managing risk in retirement, particularly something we talk about called sequence of returns risk. One of the big things that I talk about a lot is when you get into retirement, your average rate of return is actually much less important than it was while you were trying to grow your assets during the accumulation phase. What is going to be the determinant of the success of your retirement is the sequence of returns that happens in your portfolio, particularly if you have to make withdrawals or generate income off of investments that are exposed to downside risk. So we talked about what green money is. Well, it's kind of partner, sibling, is red money. So those are going to be the type of investments that a lot of folks have during their working years that make up the majority of their portfolio. The most common one is going to be stocks, but you've also have bonds. A lot of folks for years, as investors just thought, bonds are safe. They're not going to lose money. In 2022 in particular, a lot of investors found out that wasn't the case because bonds are just exposed to different types of risks than stocks are. But a lot of times folks will come to us and they will have an overwhelming majority of their money in these red money vehicles, and they need some sort of green money piece to balance out their risk to be able to generate that reliable income stream through retirement and insulate themselves from new types of risk that they'll experience as they go into that income phase.
And I suppose that makes good sense too, because a lot of people think the 401k is the investment. But really the investments are inside of the 401k, which are your ETFs, your stocks, your bonds. However, how then, if you have guaranteed income, green money, you've got that as a bucket in retirement, how does that coexist with growth assets? Because you're not going to have it all in bank CDs, right? How do those two blend together?
Absolutely. That answer is going to be different for everyone, right? Everyone's risk tolerance is different. Everyone's income needs are different. So it's going to be an individualized question. We have a risk analysis that we do with every one of our clients to help us get a starting point on what that number is. But again, once you retire, it's not about accumulation anymore. You've done that part. It doesn't mean you don't want to stop growth in its track, but it's more about that preservation income phase now. So it's finding the different vehicles, finding where that tolerance is. And again, when you're 20 versus when you're 60, your risk acceptance is going to be a wildly different number.
Right.
So reassessing that at different points is also going to be a big part of that retirement planning. You can't kind of say, hey, I'm retiring in 5 years. Let me set this now and never think about it again, because it's going to change. You're going to have that red side of your money is going to grow and contract over the years. You know, in theory, all of your money is going to kind of contract as you get further into retirement.
Kind of the job, though, right?
Yep. So it's, you've got to be able to spend what you spent your whole life saving for.
Right.
But it's just kind of reassessing that on a year-to-year basis and at different points in your life to make sure that you have enough in safe assets and that you're still comfortable with the risks you're taking, but not over-risked.
And I know there's been lots of studies that say that, oftentimes the person is their own worst part of their retirement plan, because you make decisions on markets down, I sell. It's the old, I buy high, sell low, which I don't want to do.
Correct.
How does having that guaranteed income, and you guys talk about this a lot, of the mindset and anxiety of doing that when you lay down that base of income, how does that help a person in retirement in regards to their overall plan?
Yeah, it should be a significant anxiety reducer. Because if your month-to-month paycheck, or particularly the long-term sustainability of your income, because if you have a portfolio and there's like a bad month, it's not like your next distribution isn't gonna show up. Like at that point the account's probably like basically empty anyway. So you are still getting your distributions, but you have anxiety about things that are 8, 10, 15, 20 years from now. Which is not to say that anxiety is wrong, but it's not that the next one's going to stop. It's you're worried about those longer term implications. Having some sort of guaranteed income source to complement you is really going to be key in reducing that anxiety, because if you're not making withdrawals from those at-risk assets, those red money assets, you can handle short and even medium-term levels of volatility, because if you don't have to still access that money for income, whether that's for 2 years, 5 years, 7 years, 10 years or more, maybe never, then you don't necessarily have to be worried that market this quarter was down 10%. I mean, obviously nobody likes that. Everybody always wants the line to go up every single day. But it can hopefully reduce the anxiety that, hey, this bad quarter or this bad year of returns and financial markets is not going to destroy my retirement, because the allocation of assets that I have dedicated that are at risk aren't stuff that I'm utilizing for income. Because one of the big things, you asked in the prior question about proportion, how do these complement each other? When we want to set someone up for, let's just say the amorphous concept of moderate risk, what that doesn't mean is that every investment you hold has a moderate risk profile. It means that you've got growth assets, you've got conservative assets, and you've got moderate assets, and it's about proportioning them appropriately for your risk
the whole
tolerance.
pie, not just
exactly
every piece.
So we're not just putting everything, doesn't just go into moderate risk bucket. You're having all of these different risk profiles and proportioning them appropriately for that particular investor.
I also think we all remember 2008. We saw what happened to a lot of people's retirement accounts. If you don't have that green money, we all saw those retirees finding these part-time jobs just to make ends meet, because the market went down didn't mean they had a stopgap in needs.
Right.
They continued to live, and when you're pulling that from an account that's down substantially, you've nowhere else to go. So introducing that safe money is really important to make sure that you don't run into those situations.
We're going to come back and talk about that after the break, of losses, not only from loss of market loss or some type of loss, but also with withdrawals. So let's come back on that. After the break, we're going to look at other real-life strategies for integrating guaranteed income and achieving peace of mind. Stay tuned.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
You've likely heard about the new tax bill, but do you really know what it means for you? It changes how overtime and tips are taxed, makes several tax cuts permanent, and introduces a new deduction for those 65 and older. With updates like these, now is a great time to revisit your financial strategy. I'm Cole Bruner from Buska Retirement Solutions. Let's talk about how these changes could affect you and what steps you can take. Call us at 715-355-4445 to schedule your complimentary consultation.
And now back to our weekly question and answer segment.
Before the break, we discussed stability, income predictability, and the emotional benefits, which is an important part of this, of guaranteed sources of income. So let's continue on this. So we talked about this a little bit of allocation of growth versus, assets versus income assets. How much of your portfolio should be dedicated to that guaranteed income or protection versus the growth?
Again, that answer is going to vary person to person. So first thing we look at is what is your risk tolerance? That's going to be a big part of it. The next thing is looking at income goals. Just because you have no risk tolerance doesn't necessarily mean we can put all of your money in CDs like you talked about earlier. That's not necessarily going to get you through a 20, 30-year retirement path. So you have to be kind of accepting of some level of risk, but looking at how we take those risks. There's lots of new tools that they have out there, things like structured notes, and that can limit risks. They still have them. They're just limiting that amount of risk while still giving you some exposure. So the correct number, so to speak, is going to vary person to person.
That brings up, you have that risk tolerance, but it's on your website. Someone can take it and get a number. What website do they go to take that?
They go to www.retirewithbuska.com, and then it takes our color of money risk analysis. It's only about 11 questions.
I was going to say, it's not many.
Super quick and easy. We have pictures and boxes that make it pretty straightforward and self-explanatory.
Good. So if you're looking for that starting number, go there and visit that. We talked about money coming from safer sources, CDs, bonds, annuities. What are the taxation costs, which we talked about a lot of, taxes not being how much you make, how much you keep. Taxation implications, how do they differ between annuities, CDs, and bonds?
Yeah, so the first thing is before we even get into product type, we actually have to start with the tax type of the account.
Okay.
Because that's the first and foremost part. Because if the financial product, whatever it is within a traditional IRA, the product makes no difference. It's going to be taxed at whatever your income tax rate is when you make that withdrawal. Doesn't matter if it's in a CD, a bond, a stock, an annuity, makes no difference. That's the same as if it's in like a Roth. So if it's in a traditional IRA, you haven't paid tax on that money yet. When you make the withdrawal, you'll have to pay income tax. In a Roth, you've already paid income tax on the money you put in there. It's able to grow without you paying taxes, and assuming you meet, the 5-year requirement for earnings, you can make the withdrawals from that tax-free. Now, where the product differentiation from a tax perspective does matter is in non-qualified accounts. So let's start with the annuity piece. That structure is kind of closest, I guess, to the IRA where it's tax deferred. So let's just use a hypothetical example. Let's say you put $100,000 into an annuity. It grows to be $125,000 and you start making withdrawals. The first $25,000 of withdrawals you make are going to be taxed at your income tax rate. You don't have to pay taxes on the initial premium you put in. So once the account value is below $100,000, if you're not earning interest, then you don't have to pay taxes on that money there.
Because you already did.
Because you already did.
Yeah.
The money you're already putting in there has already been taxed before.
Understood.
Now with bonds and CDs, those in a short-term sense are not very tax efficient because as they are paying out interest and paying out yield to you as the investor, you're going to have to pay taxes on that money as income when you are receiving it. So a lot of folks over the past few years have had CDs. CDs have paid out pretty comparatively to the 2010s, very decent rates. They weren't always aware that, hey, I'm going to have to count this as income.
Sure.
So you might have folks put substantial amounts of non-qualified money into CDs and end up with, hey, I have an extra $7,000 or $8,000 in income I need to account for. Which
even if you didn't take it for income, but went into your checking account.
Yep. Or if you just was reinvested back into the CD,
income to you again.
It still counts as income to you. You don't get to defer it with stuff like CDs or bonds, assuming they're not in a retirement-specific account. And so as we are looking to manage income plans, we're looking to actually manage income, for, I always come back to this, but like health insurance pre-65 is a big thing for a lot of people. We want to make sure the actual investments we're utilizing are going to be tax efficient so that we don't, kind of make a mess for ourselves by accident. That's why having kind of a comprehensive plan, not only from an investing strategy, but from a tax strategy, as well as the risk management stuff we've been talking about, is so important, because there are always a multitude of factors playing on your particular situation.
Right. And again, it's what's best for your situation.
Exactly.
How does that income floor strategies, you got CDs, things you can't lose money in, how does that protect against market volatility? You brought up 2008. Walk me through a simple example of that.
Yeah. So one of the big things to think about, that has been brought up before is the anxiety piece is so important, because, when you're working in your job, you obviously care about like your 401k,
Sure.
but if it has a bad quarter and you're, 47 years old and you're not retiring for, let's just say 15 years,
Yeah.
you don't really care that much.
Right.
It's not good. Again,
I'm not using it
we always want the line to go up, but you're probably not losing any sleep over if it's down 10% in a quarter.
Right.
That's just part and parcel for what you have to do over the course of your investing life. What we want to ideally do when we're structuring an income plan is be able to create a similar situation for you in retirement. Because we talk about retirement timelines, it gets shorter.
Yeah.
But if your retirement's 20 years long, 20 years ago was 2005.
Right.
We have
it seems like forever
we
ago
have
to
a
say that.
financial crisis. We've got, basically a mostly 15-year bull market run, a pandemic, inflation, all that stuff happens within the confines of that. And if you retire now, at 65, you're probably looking at a relatively similar timeline there.
Right.
And so we want to be able to make sure that some of the investments are allocated to these green, money sources where we know we can draw income regardless of market conditions. Therefore allowing kind of the other stuff that we have in at-risk vehicles, because we want those for the long-term growth, the very long-term sustainability of our retirement plan. But stuff where, okay, if it's down in a given quarter, in a given year, it does not break the retirement plan, because we do not have to utilize those assets. So having those, there are a variety of different product types we can utilize to create those income floors, whether it's something like an annuity, whether it's the structured note stuff that Ryan talked about, whether it's simply utilizing interest-bearing products like CDs or bonds, or some sort of dividend strategy. There are all sorts of ways we can go about constructing these different income floor strategies, but by doing so, making it so that the client can ultimately sleep well at night, even if they turn on the financial news and things, everyone there has their hair on fire, that their particular situation is not going to be significantly impacted.
Right. I suppose much like your job, if you got the growth assets, but I got income coming in, and my retirement looks the same, I might still call you, but you can reassure me my check's still showing up.
Exactly.
Right? How does that, we talk about income planning, you guys also talk a lot about leaving a legacy or leaving something to your grandkids, or however it is, that's important to a lot of people. How does having a guaranteed income affect my legacy goals?
Absolutely. So one, if you have that guaranteed income and you're not spending what's in your retirement accounts, that obviously becomes the legacy. The other side of it is if you are using an annuity that has an income rider or something and you're not necessarily using all of that income, we've seen people buy life insurance policies or just set that into a non-qualified account that now gets a step up in cost basis in a brokerage account or something like that. So you can use these guaranteed incomes to make sure that your other resources last. Or B, you can use them to purchase other resources that can be a good benefit to kids. Again, a life insurance policy is tax-free, so if you can buy that, and it's maybe something that's pricier for someone age 70 and up, but if you're using money that's coming in guaranteed, you no longer need it, maybe in your late 80s, now you're saying, hey, it's hard to spend all this money watching Price is Right at home. You have some alternatives available to you, and it's just finding the right way to do that.
Good. And I suppose if I'm leaving them what's left over, and if the more income I know, or however much it takes to guarantee that income, then I know what's left over faster and can start figuring out what to do with that.
Absolutely.
Gentlemen, thanks for joining us today. It was super helpful. Check out their website. Go take that color of money risk analysis, or give them a call if you have any questions. Have a great day. Thanks for joining us.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we provide a comprehensive approach to planning your future. We work closely with you to create a personalized, comprehensive retirement plan that reflects your unique goals and financial situation. Our team integrates investment management, income planning, tax strategies, estate planning, health insurance, and Medicare planning all under one roof. That means fewer appointments, less stress, and more clarity as you prepare for life's next chapter. Whether you're just starting to think about retirement or looking for a second opinion on your current plan, we're here to help you feel more confident about your financial future. Call us today at 715-355-4445 or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation. Let's make retirement planning easier together.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions, and today I'm joined by Zach Kihas. Today, we're diving into something that affects all of us, taxes, and how understanding the timing of when you pay them could make a big difference in your overall retirement strategy.
That's right, Cole. We're talking about what some financial professionals call the power of when. It's about using smart tax diversification to help you keep more of your money over time.
Now, before we get into the details, I want to share a quick story. You've probably heard the Beatles song, Taxman.
I sure have. It has a great line about declaring the pennies on your eyes.
Right. Well, the story goes that George Harrison wrote it because he learned that he'd have to pay a hefty tax on his earnings. He said, "I don't want to pay tax." And the people around him said, "You have to." For someone who grew up poor and finally started earning money, seeing such a big chunk of it go to taxes must have been a shock. Britain's top tax rate in 1966 was 95%. They called it a super tax.
That would have shocked me too. And while most of us aren't earning millions from record sales or playing in front of sold out crowds, the lesson still applies. You can't escape taxes, but you can take steps to control when you pay them. It just takes some planning.
And that's where tax diversification comes in. Think of your money sitting in different buckets, depending on how and when it's taxed. There are three typical main ones: taxed now, taxed later, and tax-free.
Let's break that down, Cole. The tax now bucket includes things like CDs, non-retirement investment accounts. You already paid taxes on the money you put in.
That's right. The taxed later bucket is where you'll find traditional IRAs and 401ks. You contribute pre-tax money, which helps lower your taxable income now, but the catch is when you retire and start withdrawing, you're going to owe taxes on that income.
Then there's the third bucket, everyone's favorite, the tax-free upon qualified withdrawals bucket. This includes Roth IRAs and certain life insurance policies. You pay taxes upfront on your contributions, but as long as you follow the rules, your qualified withdrawals are tax-free in retirement.
And that flexibility can be incredibly valuable later in life. Here's an example. Let's say 70-year-old Benny needs $15,000 for a new roof. He could take that money from his traditional IRA, but that $15,000 withdrawal counts as income and could increase his taxes, including on his Social Security benefits.
But Benny also has an indexed universal life insurance policy. Instead of withdrawing from his IRA, he takes a loan from his policy's cash value. That loan isn't considered taxable income, so he avoids extra taxes altogether.
That's a great illustration of how having money in different tax buckets gives you options. When an unexpected expense pops up, you can decide the most tax-efficient way to cover it.
Exactly. It goes beyond saving money. It's about how strategically you plan for taxes, because as we know, tax laws can change.
Absolutely. Let's look at another example. Suppose a woman named Sylvia starts saving in a traditional IRA at age 40. She contributes $5,000 a year for 25 years, earning a 6% return. By age 65, she's built up about $290,000.
But when she turns 70, tax rates go from 15% to 25%. Suddenly, every dollar she withdraws from that account is taxed more heavily.
Absolutely. Now, what if Sylvia had converted her IRA to a Roth IRA before the tax hike? She'd pay taxes up front when the tax rate was still 15%. Then, when she's retired and ready to withdraw those distributions, they would be tax-free for her.
In that scenario, Sylvia ends up with a bit more in after-tax income. That's the power of timing and why tax diversification matters.
And the truth is, no one can predict exactly where tax rates will be in the future. Having money spread across different types of accounts helps you adapt no matter what happens.
It also brings peace of mind. Knowing that at least some of your income will be tax-free in retirement makes planning a lot less stressful.
That's true. Now, Roth conversions and life insurance aren't the only tools for tax diversification, and they're not right for everyone. It's important to talk to a financial services professional about your specific situation.
Absolutely. They can help you determine which strategies make the most sense, whether it's managing Social Security taxes, planning around the so-called widow's penalty, or balancing how much you keep in each tax bucket.
I think the key takeaway is this. You can't avoid taxes, but you can plan for them. By diversifying how and when your money is taxed, you give yourself more flexibility and potentially more income in retirement.
Well said, and if you'd like to learn more about tax diversification and retirement planning, reach out to us at retirewithbuska.com or call 715-355-4445.
We're here to help you make informed decisions so you can enjoy the retirement that you've worked so hard for.
We'll be right back with more of Financially Speaking after this.
If you're 59 and a half or have recently changed jobs, now might be the perfect time to consider a 401k rollover. Rolling over your old 401ks could simplify your finances and give you more control from investment options and costs to how and when you make withdrawals. A rollover could give you the opportunity to partner with a financial services professional and tailor your investments to your specific needs, not the company's group plan. Call our office today to schedule your complimentary consultation and see if a 401k rollover is right for you.
With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning into this week's episode of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your current retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or schedule your complimentary, no-obligation consultation.
And if you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.